Hey everyone, this is Mike Kramer of Mott Capital. Today is Tuesday, February 20th, and it's around 4:30 New York time. U.S. markets are closed. So tomorrow we're going to start what is going to be a little bit of a busy part of the week. Tomorrow at 2 p.m. we're going to get the FOMC Fed minutes from the January meeting. There shouldn't be too much in here that's going to be a complete surprise and shock. I think Powell did a pretty good job at the press conference going over that conference, although there may be some clues in terms of what the Fed is thinking about in terms of QT. Perhaps there may even be some clues in there about what the Fed is specifically looking for when it comes to interest rate cuts. Certainly the inflation data we've gotten in the U.S. since the January meeting hasn't exactly cooperated with the Fed, coming in hotter than expected for both the CPI and the PPI. Also, wage pressures were hotter than expected in January as well, and these numbers all came out after the latest Fed meeting. So that's going to be interesting to see. We're also going to have NVIDIA earnings tomorrow after the close. This is going to be an important report just because NVIDIA has been one of the primary drivers in terms of its contributions to the overall market. Not to get too much into it, but at least as of Friday's close, NVIDIA had accounted for about 28% of the gain that we've seen in the S&P 500 so far this year. So certainly its results is going to have an outside effect on the actual direction of the U.S. equity markets. And then on Thursday, we're going to get initial jobless claims. We're looking for 216,000 versus 212 last week. Continuing claims, 1.885 million versus 1.895 million last week. S&P Global U.S. Manufacturing PMI, we're looking for 50.5 versus 50.7. Services, 52.4 versus 52.5. And composite, 51.8 versus 52. Then at 10 a.m. on Thursday, we'll be getting existing home sales. So basically after Thursday morning, the flow of news will subside, and we'll see what comes after that. And then in terms of there are some other things happening this week. On top of that, we're going to be getting a 20-year auction on the 21st at the 1 p.m. time slot, and then we're also going to be getting a 30-year TIPS auction in the 1 p.m. time slot as well on the 22nd. These are important because, again, auctions have not all gone well here in the U.S., and they have had impacts on the direction of markets during the day. So it's always at least good to be aware of these auctions, and at least being able to watch how rates respond to them can give you a little bit of a clue in terms of which way equity markets are going to be going. And then in terms of Fed speakers, not really much going on here with Bostic and Barkin tomorrow. Collins on tomorrow afternoon, and then you'll have Jefferson, Bowman, Harker, Cook, Kashkari, and Waller all speaking on the 22nd as well. So lots of Fed speakers between now and the end of the week, and again, it's good to be aware that when these people are speaking, because they could again move the markets, although I would highlight outside of the Fed minutes, Chris Waller will likely be the most important one to listen to, and he'll be, though, after U.S. markets are closed on the 22nd. And so with all of these little economic events going on from Fed speakers and such, we're going to want to, again, continue to watch two-year rates. Two-year rates have generally moved higher. We haven't really quite gotten back to this 474 level yet, and I still think there's a chance that we get there. We're still holding on to this region of support around 460. Two-year rates have had a very big move over the last couple of weeks. We've talked about this inverse head and shoulders pattern. That seems to be at least playing out. An extension of the neckline would suggest that there's still some higher to go, potentially back to this 472 area. Additionally, the pattern up here you would see, here's your straight line drop, and it would suggest, again, moving back to this 473 area. I mean, I guess you could argue that maybe it was already met by the wick that we had the other day. But again, it just doesn't seem like a completed pattern since it happened so quickly. But again, we'll keep an eye on it, and I would be looking for resistance at that level at this point. The 10-year also is currently kind of stuck below this 433 area, but generally speaking is trending higher. It does appear to be forming some sort of potentially ascending triangle, which would suggest we break out to the upside and move towards this 450 region. Again, The Fed minutes could provide the impact needed for this to happen. Additionally, initial jobless claims could provide the needed impact to have this start moving higher as well. Again, anything that shows that the job market's still remaining very strong is likely to continue to push rates up. When we swing over to currencies, the euro actually put in a pretty good candle today, and you can almost make an argument that perhaps it broke out. Although one day doesn't make a trend, it is worth pointing out that it also broke out above the 10-day exponential moving average. These are things that we tend to look for if we're going to find a change in trend. Again, we want to see the euro continue to move higher tomorrow to kind of confirm this breakout, and it would probably indicate there's upside to around 108.85, 108.90. Again, if we start seeing rates in the U.S. moving higher, it seems likely that the dollar should probably strengthen as well, especially if the economic data is stronger, and it would suggest, fewer rate cuts from the Fed. But again, the movement in the euro today was a big positive and a little bit of a surprise given how bearish the euro has been, and we'll have to see if this breakout can hold. Again, you would want to see the euro hold these levels today, not come back below this 107.70 level. If it does, it likely means you're going to come back down, maybe retest the lower Bollinger Band at 107. When we look at the pound, we don't exactly have the same level of positivity here. You can see that the pound is still kind of hovering around the 10-day exponential moving average, just barely got above it today. It got up to the 20-day moving average. That's where it failed. So again, we're kind of just stuck below this 126.30 area. We really need to see the pound get above and close above the 20-day moving average at this point. It hasn't really been able to do that. You could even argue it hasn't really even been able to close above by much over the 10-day exponential moving average. And again, for the most part, the pound's RSI even continues in a pretty much a downtrend. So there just hasn't been a lot of progress here. But if we were to break out and convincingly get above the 20-day moving average, I would think it probably sets up a return to this 127.5 area. Meanwhile, I think downside is probably more limited to around 125.20 or so. When we look at the yen, the yen's been consolidating around this 150 area. Again, this is an area where traders get a little bit nervous because this is an area where we've seen the intervene in the past. Last time was up around this 152 area. The yen ended up actually turning lower on its own, but we are up in that region again where we start hearing rumblings about the potential for intervention from the Japanese government. Again, we're holding the 10-day exponential moving average. I would think that resistance would be somewhere around 150, 130 or so, with support down at this 148.25 region, if not really this 10-day exponential moving average, because you can see that this has been serving pretty much most of the time as support as well. So as long as the yen stays above the 10-day exponential, I think there's room for it to move higher back up to this 151.25 level. Otherwise, I think we're talking about 148.25. When we move over to the U.S. markets, NASDAQ today actually closed below the 10-day exponential and the 20-day moving average, and that sets up the potential here for a little bit of a further drop, falling 80 basis points on the day. If we zoom in and look a little bit closer and we get rid of these moving averages, what we see here is that there's a support level at 17,408 that we bounced off of. This was an important level going back at least a couple of weeks, but it looks like there's something else going on here. Again, I tend to focus on these because they do tend to serve as good patterns, and good recognition of them can help us identify reversals and trends. And here you can see your reversal diamond pattern here. We were able to get below it this morning, and not a very clean break, but again a break again. And at least from the start of it, as long as if we can gap lower tomorrow and take out 17,400, that sets up a return to the lower bound here at 17,145. And then there's a bunch of gaps to fill all the way back down to around 16,700. Again, a lot of this is gonna weigh on how NVIDIA's results come out on on Wednesday afternoon. But again, if we're able to if the NASDAQ wants to go higher tomorrow, I think it takes a move. The obvious area to look for would come somewhere around the 17,685 area, which would fill the gap from this morning's opening. Otherwise, I think the risks here are that we are seeing a change in trend here in the NASDAQ, and we are seeing a change in trend in the overall markets. You can see that there has been a bearish divergence forming on the RSI moving lower. So this would be an indication that we could be at some sort of major turning point here in the markets. But again, a lot of that's going to hinge on what NVIDIA says and what NVIDIA does. The one thing that is worth pointing out is that the NVIDIA calls and puts right now are trading at extremely elevated levels. You can see that the implied volatility for NVIDIA for this week on Friday, you're looking at implied volatility, first of all, sloping up, which means that the demand is for the calls. You can also see that, you know, the implied volatility is ranging from 118% to 130%. This number likely probably continues to rise tomorrow. Once we get past the announcement, this implied volatility is going to drop. That's going to cause the value of the puts and the calls to decay. So whether or not the NASDAQ can continue to move down or move higher is going to largely depend on where NVIDIA goes after hours, again, because I showed you it's making up a very big percentage of the overall S&P, and it's even larger in the NASDAQ. And so the question really becomes is, can the news from NVIDIA be enough to override the decay in the puts and the calls? Because if the news is in line or just slightly better, it may not be enough to actually override the mechanical decay of the premiums on the puts and the calls, and that may actually just result in the NASDAQ moving lower. So you may want to watch things like implied volatility very closely tomorrow afternoon and on Thursday to also give you clues in terms of market direction. When we look at the Dow, it doesn't have those big components, so it's less impacted. You can see it's kind of just flatlining here around 38,500. We haven't really seen it break down in a meaningful way yet. Again, we need to get below the 20-day moving average. I think if that happens, you can move down to the lower Bollinger Band, 37,850. And then finally, we'll just finish with the SPX. Again, a very similar setup here to the NASDAQ with a reversal pattern in here. It already broke late Friday. Here you can see it. We basically retraced more than 61% of the initial drop of the rally. So at this point, it looks like the S&P at least could have further downside here. First of all, when we look, the S&P closed below the 10-day exponential for the first time today. It's obviously done that on a few occasions, but closing below it one day doesn't really mean anything, because obviously you can bounce right back above it. And so at this point, at least, we're still waiting to see what can happen here. But I think it's important to understand and to realize that there's also a lot of open gaps down at lower levels here that need to be filled. This gap today was filled, but then again, there are gaps that go all the way down to as low as 48,350. So it's possible here that we get a pop in the market on the open tomorrow. We move higher, fill this gap back up to 5,005. Otherwise, it's completely possible as well that we just gap lower, take out this low, and eventually retest this level here at 49.20. Again, I think a lot of how the market's going to trade tomorrow is going to be based upon what sentiment is going into these earnings for the close and the Fed minutes. And then I think once we get past those events, you're going to see the market really begin to move again. And if based on some of the things we're seeing with implied volatility, I think at this point you have to kind of favor the edge to the potential for the markets to move lower and start giving back some of these gains that we've seen since the beginning of the year. Anyway, I hope you find this helpful, and I'll be back to talk to you next week. Bye.